The number that moved markets overnight was not large by the standards of the numbers that usually move markets. It was not the announcement of a $100 billion investment program, or the collapse of a major financial institution, or the declaration of an emergency that governments use to signal that the situation has crossed the threshold requiring extraordinary measures. It was not the kind of number that appears in the banner headlines of financial news networks in the specific red or green that communicates crisis or triumph to the traders, and the analysts and the institutional investors who watch those networks with the specific professional attention of people whose livelihoods depend on being right about what the numbers mean. It was a few dollars per barrel reduction in the official selling price that Saudi Arabia applies to its crude oil exports to Asian customers, the specific pricing mechanism through which the world's largest oil exporter communicates its assessment of where the market is and where it intends it to go, a few dollars per barrel. A number small enough that a casual observer of global markets might look at it and conclude that nothing significant had happened, that the world's energy markets had made a routine commercial adjustment of the kind that occurs monthly when Aramco publishes its official selling prices, and the trading desks run their calculations, and the refineries update their procurement spreadsheets. The casual observer would be wrong, profoundly, consequentially, historically wrong, in the specific way that the most significant strategic signals are sometimes mistaken for routine commercial noise, by observers who are reading the surface rather than the depth. Saudi Arabia just cut oil prices for Asia, and the markets reacted, not in the surprised, caught-off-guard way that unexpected developments produce in financial markets, whose positioning was calibrated to different assumptions. In the specific confirming, this changes everything way that markets react when a single clear signal from the most important actor in a market confirms a strategic direction that everything else has been pointing toward, but that the confirmation itself crystallizes into undeniable clarity. The confirmation the markets received was not simply that Saudi Arabia is cutting prices for Asian customers. The confirmation was what that cut means in the context of the crisis that is deepening around it. The Gulf escalation following the Iranian attack on the U.S. warship, the Russian front collapse documented in the previous analysis, the Crimea liberation campaign underway, the oil supply disruptions accumulating from Ukrainian strikes on Russian infrastructure, and the specific strategic calculation that MBS has been executing across every dimension documented in this analysis series. In that context, Saudi Arabia cutting oil prices for Asia is not simply a commercial decision. It is a strategic communication of the first order, a move whose full significance the markets are still processing, and whose implications extend far beyond the immediate question of how much Asian refineries will pay for Saudi crude next month. Let's understand precisely what the price cut represents. Not just its immediate market mechanism, but its strategic logic, its historical context, and its implications for every actor in the global energy system, whose calculations are being forced to update by what Saudi Arabia just decided. The official selling price mechanism is the specific instrument through which Saudi Aramco, the state oil company that is the operational vehicle for Saudi oil strategy, communicates to its Asian customers the price at which Saudi crude is available in the coming month. This price is set relative to benchmarks, primarily the Dubai-Oman benchmark for Asian sales, in terms of a discount or premium whose specific level reflects Saudi Arabia's assessment of competitive conditions, its relationship management with specific customer classes, and its strategic objectives for market share and influence in the receiving geography. The OSP is not simply a price. It is a message. Every major oil market participant, every trading desk, every refinery procurement manager, every sovereign wealth fund analyzing energy sector dynamics, every government energy ministry assessing supply security, reads the OSP not just for its commercial content, but for its strategic signal. What is Saudi Arabia's view of the market? What is its assessment of competitive pressure from other suppliers? What is its intention regarding its own market share? What does the level of the OSP communicate about Saudi Arabia's confidence in demand, about its assessment of supply dynamics, about the specific relationships it is prioritizing and the ones it is willing to pressure through competitive pricing? Saudi Arabia's Asian customers are the most strategically significant component of its export market, not because Asia pays more than other customers, but because Asia is where the growth is. Chinese refineries processing 200 million barrels per month. Indian refineries, whose throughput has been growing faster than any other major economy. South Korean, Japanese, and Southeast Asian energy importers, whose combined demand constitutes the primary growth vector in global oil consumption over the next decade. The specific customers whose long-term demand trajectory is the most important single factor in the global oil market's evolution, and whose relationships with Saudi Arabia are therefore the most strategically consequential relationships that Saudi oil diplomacy manages. The price cut for Asian customers is therefore not simply a response to market conditions. It is the specific instrument of relationship deepening with the customer class that matters most for Saudi Arabia's long-term strategic positioning, a demonstration of Saudi willingness to compete aggressively for Asian market share in conditions where the Iranian supply uncertainty, the Russian supply disruption, and the general Gulf crisis environment are creating exactly the supply anxiety that Saudi Arabia's reliable, scalable, competitively priced crude is positioned to address. The history of Saudi pricing decisions toward Asian customers contains the full arc of the relationship's strategic evolution. In the early years of the Asian energy demand boom, Saudi Arabia commanded premium prices from Asian customers, the specific premium that supply scarcity and relationship inertia allowed. As Asian customers developed more diverse supply relationships, and as alternative suppliers cultivated Asian business more aggressively, Saudi pricing toward Asia became more competitive. And in the specific MBS era, the period whose strategic logic this analysis series has been tracing, Saudi pricing toward Asia has become explicitly strategic rather than simply commercially reactive. MBS's oil strategy, the deliberate production management, the OPEC Plus leadership, the non-dollar pricing development, the strategic relationship cultivation with every major oil-consuming nation, was designed to position Saudi Arabia for exactly this kind of moment. A moment when supply disruption from multiple other sources creates the conditions where Saudi Arabia's spare capacity, its supply reliability, and its price competitiveness combine to deliver a market share and relationship deepening outcome that the strategy's long preparation has made possible. The Asian price cut is that strategy's current expression, and the market's reaction to it is the confirmation that the strategy is being recognized for what it is, not a defensive response to market pressure, but an offensive deployment of Saudi Arabia's specific market position in conditions that the strategy was designed to create and is now exploiting with the confidence of careful preparation, meeting optimal conditions. The timing of the price cut, in the specific context of the Gulf crisis following the Iranian attack on the U.S. warship, the Saudi diplomatic intervention documented in the previous analysis, and the deepening supply disruption from Russian infrastructure damage, is the element that elevates it from routine commercial decision to historically significant strategic move. Saudi Arabia is cutting prices for Asian customers at the moment when those customers are experiencing maximum supply anxiety about every alternative source. Russian supply disrupted by Ukrainian infrastructure strikes, whose cumulative effect has been reducing Russian export capacity in ways documented exhaustively in previous analyses, Iranian supply uncertain due to the succession crisis, the food shortage, the IRGC radicalization, and the military confrontation developing in the Gulf following the attack on the U.S. warship. Red Sea logistics disrupted by Houthi operations that have increased shipping costs and transit times for every route that passes through the strait connecting the Red Sea to the Indian Ocean. The specific combination of supply uncertainties facing Asian energy importers in the current period is the supply anxiety environment that Saudi Arabia's price cut is entering with the specific offer of reliable, scalable, competitively priced crude from the world's largest conventional oil producer. An offer whose timing is not accidental. An offer whose specific terms, the precise discount level, the volume flexibility, the delivery guarantees, reflect Saudi Arabia's calculation of what is required to convert Asian customers' current supply anxiety into the specific long-term supply relationship deepening that the strategy has been building toward. The offer is not simply commercial, it is strategic. Asian importers who deepen their supply relationships with Saudi Arabia in response to the price cut are making a strategic choice, not just about where to source the next month's crude, but about which energy supplier they trust with the strategic importance of their energy security. That trust, once established through the specific experience of Saudi Arabia being the reliable supplier in a crisis-disrupted market, is the foundation of the long-term relationship leverage that MBS's strategy has been building with the patient calculation of a leader who thinks in decades rather than quarters. The Chinese response to the price cut is the most strategically significant market reaction to track. Because China is simultaneously Saudi Arabia's largest single customer, the architect of the Saudi-Iran normalization that the current Gulf escalation is testing, and the geopolitical actor whose energy security decisions most directly shape the global strategic environment. China has been managing its energy supply situation in the current crisis with the specific combination of commercial opportunism and strategic concern that characterizes Chinese energy policy in disrupted market conditions. The commercial opportunism involves the exploitation of whatever discounts are available from suppliers whose market situations create pricing pressure. The specific acquisition of Russian crude at deeply discounted prices that the sanctions environment created has been the most prominent expression of this opportunism, with Chinese refineries becoming the primary destination for Russian crude that European customers were redirected away from by sanctions. But the Russian discount has always been a relationship of convenience rather than of strategic alignment. China has been buying discounted Russian crude because it was available and because the price was right, not because China's energy security strategy is built around Russian supply reliability in the way that Saudi supply reliability represents. The specific reliability distinction between Saudi crude and Russian crude has been abstract in normal market conditions. Both suppliers delivered reliably, and the reliability distinction was theoretical rather than operational. The Russian infrastructure damage documented in previous analyses has converted that theoretical distinction into an operational one. Chinese refineries are now experiencing the specific reality of Russian supply unreliability, the delivery delays, the reduced volumes, the logistics complications that the Saudi supply offer is positioned to contrast with. Saudi Arabia's price cut arrives at exactly the moment when Chinese strategic planners are revising their supply diversification calculus in light of the Russian front collapse and the Iranian Gulf escalation. The price cut reduces the commercial incentive for continued concentration in Russian supply while simultaneously demonstrating the specific reliability advantage of Saudi supply. The reliability of a supplier whose capacity is not subject to the disruption risk that Russian infrastructure damage has created, and whose political stability, while always a consideration in the Gulf, is currently demonstrating the specific management capability that MBS's response to the Gulf crisis has showcased. The deepening of the Saudi-China oil relationship that the price cut is designed to accelerate is itself a component of the broader non-dollar financial architecture that previous analyses documented. Chinese purchases of Saudi crude at the competitive prices the cut establishes are purchases that both Saudi and Chinese policy has been orienting toward yuan-denominated settlement, the specific non-dollar pricing mechanism whose development contributes to the petrodollar erosion that both Saudi strategy and Chinese policy have identified as a long-term strategic objective. Every barrel of Saudi crude that moves through yuan-denominated settlement rather than dollar-denominated settlement is a barrel contributing to the critical mass of non-dollar commodity trade, whose accumulation is the foundation of the alternative financial architecture that previous analyses have traced. The Indian response to the price cut is the second most strategically significant market reaction. India has been the most aggressively commercial of the major Asian oil importers, exploiting every available discount from every available source with the specific focus of a nation whose energy import bill is one of its most significant economic vulnerabilities, and whose management requires the most disciplined commercial procurement available. Indian refineries have been among the primary-secondary market participants for Russian crude at sanctioned discount prices, a relationship that has served India's commercial interests while creating the specific geopolitical complications that India's management of its relationship with Western partners has required ongoing diplomatic attention. The relationship has been managed with characteristic Indian strategic dexterity, maintaining the Russian supply relationship as a commercial asset while carefully avoiding the degree of political alignment with Russian positions that would create consequences in the Western relationships that India's broader strategic interests require. The Saudi price cut introduces a competitive alternative to Russian discounted crude at a moment when the Russian supply disruption documented in previous analyses is adding a reliability risk premium to the Russian discount that reduces its net commercial value. The equation that made Russian discounted crude the commercially optimal choice for Indian refineries, deep discount offsetting the political management cost, is changing as the discount's value is reduced by the reliability risk premium and as the Saudi alternative offers competitive pricing without the reliability risk and without the political management cost. Saudi Arabia offering competitive pricing to Indian customers at the moment when Russian supply reliability is declining is the specific commercial and strategic combination that MBS's strategy was designed to create. India choosing Saudi crude at competitive prices over Russian crude at discounted but increasingly unreliable prices is India making a strategic supply diversification choice whose relationship implications extend far beyond the commercial transaction. Implications for the Saudi-India relationship, for Indian energy security architecture, and for the specific alignment of Indian interests with the Gulf security framework that Saudi Arabia's regional positioning represents. The market reaction to the price cut encompasses several dimensions that the immediate reporting on oil price movements does not fully capture. The oil price reaction is the most immediately visible. Saudi Arabia cutting prices for Asian customers in a disrupted market environment does not straightforwardly reduce global oil prices because the specific market dynamics of supply-constrained conditions mean that competitive pricing for one customer class does not necessarily translate into price weakness across the entire market. When total supply is reduced by Russian infrastructure damage and Iranian uncertainty, Saudi Arabia offering competitive pricing to Asian customers is filling a supply gap rather than adding supply pressure. a dynamic whose market price implications are different from the conventional supply increase price reduction that competitive pricing sometimes signals. The Saudi price cut for Asia is being parsed by market participants for its specific signal about Saudi Arabia's view of the market balance, whether the cut reflects confidence in demand that makes competing for market share at lower prices strategically rational, or reflects concern about demand that makes defending market share against declining oil prices the operative strategic logic. The consensus market assessment is reading the cut as the former, rather than the latter. Saudi Arabia cutting for Asia in the current disrupted supply environment is being read as competitive offense rather than defensive retreat, as the expression of a producer whose confidence in its strategic position is sufficient to invest market share and relationship, deepening at competitive prices, because the long-term relationship value exceeds the short-term price concession. The currency market reaction is the second dimension of the market response, specifically the reaction of currencies whose value is most directly linked to oil price dynamics. The Gulf state currencies, the Russian ruble, the currencies of major oil importing nations whose current account positions are most sensitive to oil price movements, all are processing the Saudi price cut's implications for the oil market trajectory in ways that the immediate price move does not fully capture. The ruble's reaction is particularly significant. Russian currency dynamics are one of the most direct financial indicators of the Russian economy's condition and of the specific pressure that the combination of military losses, infrastructure damage, and now competitive Saudi pricing is creating for Russian state revenues. A Saudi price cut that deepens Chinese and Indian supply relationships with Saudi Arabia at Russia's expense is a Saudi price cut that reduces the market available for the Russian crude, whose revenue is the financial foundation of the Russian war economy's remaining functioning. This is the dimension of the price cut whose strategic significance is most directly relevant to the Ukrainian conflict that has been the primary thread of this analysis series. Saudi Arabia cutting prices for Asian customers is not simply a commercial decision in the Gulf energy market. It is a financial pressure on Russia, a further tightening of the resource constraint that Ukrainian military operations have been imposing on Russian military sustainability through the deep strike campaign against Russian oil infrastructure. Saudi Arabia is competing for the Asian market share that Russian crude has been serving. Every barrel of Saudi crude that replaces Russian crude in an Asian refinery is a barrel of revenue that flows to Riyadh rather than Moscow. And every barrel of revenue that flows to Riyadh rather than Moscow is a barrel's worth of reduced Russian capacity to fund the military machine whose front is collapsing simultaneously. The financial market reaction beyond oil and currencies reflects the broader processing of what the Saudi price cut signals about the crisis deepening in the Gulf and its implications for global economic conditions. Equity markets in major oil importing economies are parsing the cut for its implications about energy cost trajectories. Lower energy costs for importers create the specific economic relief that growth prospects in energy importing economies most benefit from. Bond markets are incorporating the cut's signal about economic conditions and monetary policy implications. The inflationary pressure from energy costs that central banks have been managing for years is being affected by the Saudi pricing decision in ways that monetary policy models are being updated to reflect. The global financial system's information processing function is converting a few dollar change in a pricing announcement into the distributed reassessment of economic conditions that efficient markets produce when significant signals arrive. The specific reaction patterns reveal something important about how markets are reading the overall strategic situation. The Saudi price cut is being processed not in isolation, but in conjunction with every other signal about the crisis environment. And the combined reading is a picture of a world in which supply disruption and strategic realignment are interacting in ways that make the oil market's near-term trajectory more uncertain, and Saudi Arabia's strategic position more dominant simultaneously. The crisis that is deepening around the Saudi price cut, the Gulf escalation, the Russian front collapse, the Crimea liberation, the Iranian succession instability, the Hormuz tension, is not background context for a commercial decision. It is the specific strategic environment that the decision is designed to exploit and to shape. MBS's strategy has always been about using oil policy as a multidimensional strategic instrument, not simply to maximize revenue in the short term, but to use Saudi Arabia's specific market position to shape the relationships, the financial architecture, and the geopolitical alignments whose configuration determines Saudi Arabia's long-term strategic position in the emerging multipolar world order. The deepening crisis is the specific condition in which that multidimensional use of oil policy produces its most significant strategic returns. When supply from multiple other sources is disrupted, uncertain, or unreliable, Saudi Arabia's reliability is a strategic asset whose value is higher than in normal market conditions. When Asian customers are reassessing their supply relationships in light of the crisis, Saudi Arabia's competitive pricing is an invitation to deepen exactly the relationships that Saudi strategy has identified as most valuable to its long-term positioning when the global financial architecture is being restructured by the specific pressures documented across this analysis series, Saudi Arabia's willingness to accept yuan's settlement for competitively priced Asian crude is a contribution to exactly the alternative financial infrastructure that both Saudi and Chinese policy has been building toward. The Vision 2030 dimension of the price cut deserves explicit acknowledgement because the connection between Saudi oil pricing strategy and domestic economic transformation is more direct than the conventional separation of foreign policy and economic policy suggests. Every Asian customer whose supply relationship with Saudi Arabia deepens as a result of the competitive pricing becomes a potential investor, a potential technology partner, a potential participant in the specific projects whose development Vision 2030 requires. The relationship capital that competitive pricing builds in Asian capitals is not simply energy market capital. It is the broader bilateral relationship capital whose accumulation is the diplomatic foundation of Vision 2030's international partnership strategy. Chinese technology companies whose government is receiving the signal of Saudi supply commitment through competitive pricing are Chinese technology companies whose potential involvement in Saudi Vision 2030 technology development projects is facilitated by the bilateral relationship that oil supply deepening creates. Indian companies whose government is receiving the same signal are Indian companies whose participation in the Saudi economic transformation is made more likely by the supply relationship, whose depth reflects Saudi Arabia's investment in the bilateral relationship. The commercial and the strategic are not separable in Saudi Arabia's Asian pricing strategy. They are the same thing expressed in the same instrument. The markets reacted to the Saudi price cut because the markets understand, in the aggregate intelligence that efficient markets represent, that the price cut is more significant than its face value, that it is the current expression of a strategy whose consistent execution has been reshaping the global energy order in ways that the individual announcements, taken separately, do not fully communicate, that the few dollars per barrel that changed in an Aramco pricing announcement are not simply the result of supply and demand arithmetic in the Asian crude market, but the expression of a strategic vision whose scope and whose ambition the immediate price signal only partially captures. MBS's strategy is working. The oil crisis is deepening, Saudi Arabia is gaining, and the price cut for Asian customers is the specific current demonstration that the strategy's execution is continuing with the consistency and the confidence of a leader who prepared for exactly these conditions and who is using them with precisely the combination of commercial aggressiveness and strategic calculation that the moment demands. The crisis deepens, the markets react, Saudi Arabia gains, Russia loses market share it cannot afford to lose. China deepens the supply relationship that Saudi strategy has been cultivating. India recalibrates its supply architecture in Saudi Arabia's direction. And the global energy order, whose transformation MBS has been engineering, continues its evolution toward the configuration that his strategy was designed to produce. The few dollars per barrel that changed overnight are moving the world, and the full significance of that movement will be visible only when the crisis, whose depths we are currently in, has reached its resolution and the specific configuration of the world it has produced becomes clear enough to assess completely.